my 21st year here without a down year, and really just stay disciplined to those trades over time. And I started to develop a process.
One trade should mean nothing.
The market is now no longer going down on what is seen as the most bearish news there is.
Until the tape confirms anything you want to do, you just have to wait.
And it's not just some random stop. It's a stop that actually makes sense, A, on the chart, because it's a new low, and B, according to my process. Don't fight the tape. Don't think you're smarter than the market. And there is nobody out there that's going to teach you how to turn $10,000 into $1 million in a year. It doesn't exist.
It's not about what you make today or this week or this month or this year. It's all about over time.
All I'm trying to do is make money. And to me, the simplest way to make money is to go opposite people that are losing money. I'm Jason Shapiro. Welcome to my little presentation here. Just to give you a little background, I am a futures trader. I own a CTA called JS Trading, for which I manage some institutional accounts. And I also am part of a website called crowdedmarketreport.com, where I produce a newsletter every week, and we have a Discord page where our members get on there and talk about the markets and various trading processes and risk management and all kinds of things like that. Just to go back into sort of how I started, how I got into trading the markets, I think my story is pretty similar to many people. I started trading when I was 22. I'm 55 now, and I started trading because I was working at a job. At the time, I lived in Hong Kong, and I worked at a job that I was kind of bored at. And there was a bull market going on in the Hong Kong stock market. And it seemed like a pretty good place to try and make some extra money. So I started to buy, and the market was going up, and I was making some money. And I quickly came to the conclusion of, hey, if I put $100 in something and it goes up 10% and I make $10, well, then why don't I put $200 into it and make $20? So I started to sort of utilize leverage that way and ride the bull market up. And it was a bull market. And as a young person with very little experience, this leverage idea seemed like a great idea because it was working. But of course, in the end, I had no way of knowing when this bull market was going to end. And when it did end, I didn't know it. And the market started going down, and I was buying the dip, and it was sort of like, let's double up to make up. And all that did was lose me more money. And in the end, I ended up back right where I started and had lost all the money that I had made during the bull market. And then at some point, I learned about this other great thing, which was shorting the market. If it was going down, then why not get short and make money on the way down? And this ultimately was even more enjoyable in a way than making money on the upside, because you're making money while the market's going down. Everybody else is losing money and you're making money, and it feels like you're a genius. So I did that for a while. And of course, I had the same issue, which was that I had no idea of knowing when the market was going to bottom and start going up again. And certainly when it started to go up at first, it wasn't because of any fundamentals. The market, there was nothing any better than there was before, but the market started going up and I was shorting it. And again, in the end, I ended up in the same place I started, which is that the money that I had made on the short side, I had then given back and lost. So this was probably 5 years into trading now, and I'm basically at the same place where I started. So I decided that I was going to educate myself about everything that I could about trading and markets. And I went into, fundamental analysis, and I went into technical analysis, and, Fibonacci retracements and breakouts and head and shoulders and all these different things as well, and did a lot of study into that. And from there, I kind of started trading both sides based on all that type of stuff. And I did that for about 5 years. And the results were a little different. I was making and losing and making and losing. But in the end, really, I pretty much ended up in the same place that I started after a bunch of false starts and give backs and false starts and give backs. So now I'm sort of 10 years into this. And I decided the good point was, as part of my reading of trading books and psychology books and all that stuff, was the idea of keeping a trade journal and keeping a history to be able to study. So I had done a very good job of that. So at that point, I went back and I really went through my trade journal. And what I tried to do was figure out which trades actually made money over time, which kind of process, which kind of idea made money over time, rather than just made money one time and lost money over time, and which ones didn't. And obviously, I tried to eliminate the stuff that wasn't working over time and focus on the stuff that was working over time. and really just stay disciplined to those trades over time. And I started to develop a process of what works and over time and what doesn't work. And that was really the basis of what I do now, 20 something years later. And I'll say that since I did that, my trading has been pretty successful. I'm going on my 21st year here without a down year, which is not easy to do. And it's not like I'm making hundreds of percent a year. I'm an institutional money manager. I try to put about 15% a year without ever drawing down 5%. So that's kind of where I'm at now. I'm running the same process that I've been running for 20 years and being very disciplined about doing that. So now I'd like to get into sort of what my process is and how I developed it. And really, it starts with the fact that I have witnessed that over time, the majority of people who are trading lose money. It's a very high number. It's in the high 90% of people lose money over time trying to trade the markets. So my thought becomes, well, if 90 something percent of people lose, if I can do opposite of those 90 something percent of people, then I can capture in gains what they are getting in losses. It's a pretty simple concept, a little harder to do, but that's at the very base of it, what I'm trying to do. And notice, I'm not trying to be necessarily smart, okay? I'm not trying to outthink the market, which I think is a dangerous thing to do over time. I'm not trying to let the market do what I think it's supposed to do. All I'm trying to do is make money. And to me, the simplest way to make money is to go opposite people that are losing money. So how do I do that? It starts with the idea of what my basic premise is for markets, which is what is the discounting mechanism, right? And I think most people and most books and whatnot will talk about price of an asset as its discounting mechanism, right? So in other words, this is pricing in all this good news because the price has gone up, or this is pricing in all this bad news because the price has gone down. I don't look at it like that. I think that the discounting mechanism in the market is positioning. So in other words, it's not this thing has gone up a lot, so it's priced in all the good news. It's everybody is long this thing, so it's priced in all the good news. Or everybody is short this thing, so there's a good chance that it's priced in most or all of the bad news, right? Because the market is pushed around, obviously, by money going in and money going out. So if you take a very extreme example, which could never happen, but just to make the point, if everyone in the world had all of their money invested in one asset, then there's no way it could go up anymore because there'd be no more money to go into it, no matter what the news was. The thing could, whatever, take over the world at that point. It doesn't matter because there's no money left to go in it. So that's kind of an extreme example of what I'm trying to do. So how do I figure out or measure when people are super long or super short? And as a futures trader, the data that I like to use a lot is the commitment of traders data, because this is released every week and it shows where people are positioned in the futures markets, right? So I use that extensively. And what I do is I take the commitments of traders data and I turn it into an oscillator, and it becomes obviously an overbought or oversold oscillator. So if it's like 95 or above on my oscillator, it's indicating to me that people are way too long. And if it's 5 or below, it's indicating to me that people are way too short. So when it hits those levels, I am looking to, buy it when they're too short or sell it when they're too long. And clearly the commitment of traders data is not perfect. Just like any data set is not perfect. It doesn't work all the time. Just like anything doesn't work all the time. So we have to add another layer on top of that. It's not like, everyone's long short it. Everyone's short long it. We need to add another layer of top of that. And what I like to do as my first layer on top of that is I need the market to confirm what I want to do first, right? And I think that's important, by the way, for any way that you trade, right? I don't care what it is. The market should confirm what you're thinking first, right? You might be a value investor. I think this stock is super cheap. I'm going to buy it. Okay. Let the market confirm it first. I think this stock is super expensive. I'm going to sell it. Okay, let the market confirm it first. Market confirmation is extremely important in all processes, including mine. So what do I mean by market confirmation? Well, for me, I'm picking turns, okay? So the market's been going down, 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 down. Everyone's gotten super short. I'm looking to pick the turn. So what is market confirmation down there? For me, what it is I like to refer to it as a news failure event. So let's say the market's going down. The easiest one to pick, because everyone sort of follows it, is the stock market last year was going down. And we kind of know why it was going down. The Fed was raising rates because inflation was too high. CPI kept coming out high. PPI, all these data sets kept coming out too high. And it meant the Fed needed to keep raising rates and drain liquidity. And drain liquidity is bearish to the stock market. And so the stock market was going down for those reasons. So we're told. So when the market actually did bottom, which was in early October, what we saw was a CPI came out and it was actually higher than was expected and was the highest number of the year. And so that was very bearish. And what happened was the stock market went down that day and actually closed up on the day. And there it is. That's market confirmation to me. That's news failure to me. The market is now no longer going down on what is seen as the most bearish news there is. That's market confirmation. And that's when I buy. Okay. And same thing on the upside. Market's been going up for all these bullish reasons. Suddenly you get more of that bullish reason and the market does not go up on it. It probably has a reversal day. Most days it'll do one of these candles, where it goes up and closes on the low, reversal day candle type of thing. Not always that, but a lot of times that. And so I sell it there. So that's sort of my first buffer towards the COT is not perfect, right? It keeps me out of trouble. And then the second buffer, of course, is risk management, both on an individual trade basis and on a portfolio basis. So individual trade. So let's take that S&P, for example. If everybody were short and we get this CPI number that comes out worse than expected and the market goes down and rebounds and closes up on the day, I will be getting long on the close of that day. I'm picking the turn. So by definition, if it goes and makes a new low, then I didn't pick the turn. So that's where I'm stopped. So I know where my stop is, right? The low of that day. I know where my entry is, which was the close of that day. I know how much I want to risk per trade, which for me is 70 basis points per trade, but for you, it could be something else. Everybody's something different. I pick 70 basis points because historically that's what gets me to a volatility of my portfolio of 7 to 8%, which is what I'm targeting. But basically it's 70 basis points. So I know my entry, I know my exit, I know how much I want to risk on that trade. Or I should say, I know my entry, I know my stop. I know how much I'm willing to lose on a trade, which is 70 basis points. So therefore, that's how my trade gets sized. All right. It's pretty simple. So that's sort of buffer number 2 for being wrong, right? Which is a stop. And it's not just some random stop. It's a stop that actually makes sense, A, on the chart, because it's a new low, and B, according to my process. I'm picking a turn. The market makes a new low. It's not a turn. So I'm out. And I think that that's an important thing, no matter, again, how you trade, right? Whatever it is, you're long something because you believe that this means you should be long. Well, at what point does the market say that this is not happening anymore? Because that's when you should stop out or get out, right? And it doesn't matter what it is, but you have to be disciplined to that process, And just as an example, like my trades historically are profitable less than 40% of the time, which means that I'm wrong over 60% of the time. All right. But I lose 1 unit when I'm wrong, and I make somewhere around 3.5, somewhere between 3.5 to 4 units when I'm right. So if I can lose 1, make 3.5, lose 1, make 3.5, lose 1, make 3.5, then over time, my account grows. And I think that's a very important concept. People are looking to be right a lot. I'm looking at risk reward, right? And I believe that that's what this positioning does. It doesn't necessarily give me an advantage as to whether the market is going to go up or down at any given time. But I think it gives me an advantage as to the risk reward of whether it's going to go up or down. The up or down is probably still 50-50, but the up becomes 4 and the down becomes 1. So I want to be long. And that's really the most important thing of my process, along with the risk management. And as I was saying, the next level is on a portfolio basis. So I have a trade on and I have another trade on and I get another trade and another trade. And suddenly I'm looking at the portfolio and I say I'm risking 70 basis points a trade. But what happens if, for example, I get long S&P, Dow, Nasdaq, and Russell, and I'm risking 70 basis points on each one? That's clearly not really 70 basis points a trade, right? Because those are very correlated markets, although not this year, but in general, they're very correlated markets. So therefore, I'm not going to put the full size on. And that's an exaggerated example, because suddenly I have a dollar trade on, or I have a commodity trade on, and a stock trade on, and a fixed income trade on. And so I'm kind of looking at my portfolio looking at the correlations between the things. And it comes down to sort of usually the simple risk on, risk off type of idea. And I will adjust the size of my ultimate positions based on the correlations across the various positions that I have on. And sometimes the correlations break, but, and I'm watching that. I don't run like value at risk stuff because it's so delayed with the correlation breaks. So really what I spend most of my day doing when I'm watching the markets is really watching these correlations and seeing how they're keeping steady or if they're not keeping steady, and therefore my portfolio should be adjusted or not adjusted based on that. So that's really basically what my process is. And then in getting out, again, my getting out has to fit into what my process is as well. So if my process is people are super short, so I'm getting long, well, then people are no longer super short. My edge is gone. So that's when I get out, right? So I buy it. They're super short. We get one of these news failure market confirmations event. I buy it. Now I'm watching the data. And when it goes back to neutral on my oscillator, 50, I take my profit because that was my job, right? It's not to say it's not going to keep going up until they get super long. And in fact, when I have tested this data, what it's told me is I would make more profit if I just hold the thing all the way up until they get super long, get out and get short. But what happens after the halfway point, after the neutral point, is my returns start to get a hell of a lot more volatile relative to the extra return I'm getting. And I don't really want that, first of all. I want to maximize my Sharpe, or I want to maximize my return to drawdown, first of all. And second of all, as a money manager that is offering a service to clients, that's the service that I offer. Most of my clients are diversified sort of hedge fund clients. They either a fund of fund that have a bunch of hedge funds in there, or a fund of CTAs that have a bunch of trend followers in there. And my job is to kind of catch those turns. And once it sort of gets past neutral and the market continues to go up, that's really more the trend follower job. So they do that. I do my job. They do their job. My client's happy because they have a portfolio of negative correlated return streams. So that's how I get out. And that's my process right there. It's really pretty much that simple. And what I would say is you shouldn't look to be, whether you believe what I'm saying or not, or you believe in what I'm saying or not. The idea here is not trade like me. Okay. Hey, I've got good returns and I've got this and I've got that, so you should trade like me. You can't do that. Just like I can't trade like you, right? You have to trade like you. But I think the idea is some of this data that I'm talking about and some of these thought processes that I'm talking about can help you to improve your trading as you do it, right? I've seen many, many times, especially now that I have this Discord page, where there are people who try to just put on the same trades that I do. But like I say, over 60% of my trades lose. So the chances of losing 3 or 4 in a row is pretty high. So you lose 3 or 4 in a row and all of a sudden you think, oh, this guy doesn't know what he's talking about. I'm not going to do his trades anymore. And then of course the next 2 work great. And they make 4 times what we would have lost, and then you chase the next one and that one ends up being a loser. And suddenly the whole thing just becomes a mess. Until you believe very much in what you're doing, or unless you believe very much in what you're doing, you're not going to be able to be disciplined to stick to doing it. And that's an important thing. If you have a process that works over time, you have to be able to keep doing it even when it's having a drawdown. And nothing works all the time. Everything has drawdowns. So you have to believe so much in what you're doing that you're going to be disciplined enough to stick to it. So that's why that's one of the reasons why I encourage people not to just take my trade ideas, right? Use some of these concepts to improve upon your trading is the best thing that can be done with this. So the next thing I thought I would get into, since I've talked about what kind of has worked for me and what continues to work for me and what I focus on now, is to take a look at things in the past that haven't worked for me, because I think that's an important thing to understand. And as you eliminate things that don't work, and really the number one thing on a more broad basis that hasn't worked for me over time is when I think I'm going to be smarter than the market, right? And I'm trying to be contrarian. The market's going up, so I'm trying to go short, or the market's going down, and I'm trying to get long because it's oversold or overbought or all those type of things. And there's many examples of this that I can unfortunately cite. But I'll go to 2 that I like to talk about a lot. There was a period, and this is all before I started using this process and looking at the commitments of traders data. This is the S&P right about here, 97. In 1997, the S&P was here. and I was trying to short it. I thought it was too high. I thought it was going up too fast and all this kind of thing. And I was fighting the tape and I was shorting it because I wanted to be the hero. And it was just wrong all the time. And I was getting stopped out on a consistent basis. And at one point in here, I believe it was this right here. It might have been this little move down here, but I remember that Alan Greenspan, who was the chairman of the Federal Reserve, came out and made a comment about there might be some irrational exuberance in the stock market. And the market gapped down that day. And I was short. And I was thinking about what a hero I am, about how only me and Alan Greenspan are the only ones that really understand what's going on. And this is the big one, and I'm going to catch this and all that. And by the end of that day, the stock market actually closed up after gapping down on that Greenspan comment. And it continued to go up. It was like right around here, and it just continued to go up and up and up and up. And the lesson there was, don't fight the tape, right? The tape is telling you, it's even when Alan Greenspan is giving you bad news, the market's closing up, right? Don't fight the tape. Don't think you're smarter than the market, okay? Be patient and wait for the market to confirm whatever it is you're believing. Don't just get in front of it because you can get run over. There's the saying, and there's a saying for a reason. The market can be irrational a lot longer than you can stay solvent. And that's a fact, right? And another great example of that was the Nasdaq in late 1999. Now, in late 1999, what we had was the internet bubble 1.0. And it was obvious to anyone paying any attention that this was a bubble and that the valuations on these stocks were completely unjustifiable, completely ridiculous, right? And there was the classic thing going on where the shoe shine boy was literally giving stock tips, right? That was the world we were living in 1999. So me, trying to be Mr. Contrarian again, I'm saying, well, let's get short the stock market. Well, you know what? It was pretty obvious around, I'm going to look at this NASDAQ chart into the beginning of 99, right? Which is really when it was getting ridiculous. The NASDAQ was trading somewhere around 4,000 and it was ridiculous. Okay. I'm telling you, the valuations are ridiculous. The psychology and the momentum and this whole thing was ridiculous. Well, you know what? The NASDAQ went all the way up to 8,100. It doubled that year. Okay. In less than a year because it was irrational longer than I could stay liquid. Right. And this gets to, and ultimately the NASDAQ topped in February of 2000, around 8,100. And this is when I actually, the commitments of traders came to me, right? This is when I started looking at that because I was like, how can I find a way that will stop me from shorting this thing way too early based on things that maybe the market doesn't care about, right? And this is the commitments of traders for the NASDAQ futures. And you can see the speculators, which are the blue lines, never really got super long, okay, until the middle of December, right? And the market ended up topping in February, but this would have kept me from shorting the NASDAQ for that whole year, right? I wouldn't have started shorting it until here, right? And even then, I would have been waiting for a market confirmation, but it would have kept me. And that had a very strong effect on me where I was like, okay, maybe I need to start looking at this type of data, this positioning data, rather than just me saying the market's gone up too much and therefore it has to go down because that was causing me nothing but trouble, right? So those are two examples, I think, of what not to do. Right? Just because it's gone up a lot doesn't mean it's a short. Just because it's gone down a lot doesn't mean it's a buy. Just because it's overvalued doesn't mean it's a short. Just because it's undervalued doesn't mean it's a buy. Don't fight the tape, right? Wait for the tape to confirm what you're thinking before you do anything. All right? I think it's a very, very important concept. Right? So here are some examples as to the trades that I am talking about using the commitments of traders and using this market confirmation type of thing. And I'll try to give some recent examples just so we can keep it current and even the trades that I currently have on. But this is the 10-year notes. And if you look, again, this is the commitments of traders report. The red shows the commercial traders. The yellow shows what they call small speculators. And the blue shows large speculators. And I am looking to be at the market turns when large and small speculators are super short and therefore commercials are super long. I'm looking to get long. So we came into sort of February, March, late February, finding that the speculators were super short. I'm looking to get long starting in late February, and I'm looking for this market confirmation type of thing. And what we had, I believe it was this day right here on the 10-year chart, right, which was March 9th, so about 2 weeks after we really started seeing this massive short positioning by speculators, we had a news failure event. You can see the reversal day on the chart on March 9th right here. And it was some kind of economic news that, or inflationary news that was stronger than expected. And the 10 years went down and they closed up on the day. So I'm getting long on the close that day with my stop at the low. And lo and behold, 10 years went from about 111 to the 116 area in a very short period of time. And this was during the beginning of the latest banking crisis thing. And I get comments a lot like, well, you couldn't have known that banking crisis was going to happen. And I think that's an important point because it's true. I couldn't have known that banking crisis was going to happen, nor could just about anybody know. But what I did know was people were super short and that the risk reward was to be long, right? And maybe if the banking crisis didn't happen, maybe the 10 years would have gone down, taken out the lows, and I would have taken a loss. I don't know. But what I do know is the risk reward was in my favor. And so I made a very quick, almost 6 points on a 10-year trade in just a few weeks. And then the COT went neutral and I got out. And the reason I say COT went neutral is really because the small speculators here, ended up getting long. You can see the large specs are even shorter now than they were there, but the small speculators are long. So I need all three to line up for me to put on a trade. So therefore, I'm not buying fixed income now. Even the 2-year notes, by the way, right now, which are ridiculous, right? You look at the large specs are mega short, record ever short, but the small specs are still long. So this is keeping me from getting long 2 years here. But anyway, that's sort of one example of a trade. Some of the other examples, like the trades that I have on now, or that I've been doing this year. This year, I was getting long the Nasdaq earlier in the year, and you can see in this area, beginning of the year, this is sort of mid-January, speculators started to get very short. So I was, of course, getting long on a news failure event. And we rode the Nasdaq long until it went neutral. You could see it was going neutral around this level, April. But lo and behold, as they were getting out of their shorts in the Nasdaq, they were getting short the S&P. So I was looking to get long S&P. And there was a day in there somewhere where there were, again, some bad news came out and the market closed up and I got long the S&P, which is what I currently am. And another one that I have on right now, for example, is this euro. You can see speculators were getting massively long euros starting in February. Came off a little bit in March, but starting April started to get massively long again. And I was looking to get short starting early April was when I really started to look at it. And then we had an event, out of Europe. Lagarde spoke, or it was a Euro central bank meeting or whatever. And that was more hawkish than expected, which I believe was this day right here, all right, which is March 4th, if I'm not mistaken. And again, the euro went up, closed down. I got short against that high. It took a little bit of a while, but now it started to work, and right now it's working. It's not to say it won't go out and get stopped out. I don't know, but I will stay with this short until I either get stopped out or the commitments of traders goes back to neutral. All right. So that's kind of an example of these trades. And clearly I could give you a whole bunch of examples where they didn't work, where I got short up here and it ended up going through the highs and stopping out, or going through the lows and stopping out. And that happens a lot. Like I say, more than 60% of the time that happens. But even if it were this euro trade, I was risking maybe a half a point on this, and I am already 3 points in the money. So, I mean, that's a 5-6 to 1, return to risk from when I put the trade on. So that's kind of examples of how these type of trades work. And I want to point out again, because I think it's so important, and I said it when this happened, you don't have to trade like I trade in order to make this stuff work for you. Trend following. I'm almost an anti-trend follower in a way, right? Not totally, because I'm not picking a term because of the trend, the price, but a lot of times it ends up being anti-trend following. But trend following works over time. It has proven to put up positive returns over time, right? But if you were a trend follower, then there was a good chance that you were short the fixed income markets this year. And if you were watching the commitments of traders starting in February, you could see 2 years, 5 years, they're getting very short. 10 years, they're getting very short. And if you're looking at that, you might be able to say to yourself, well, yes, I am short the fixed income markets because that's where the trend is, but it's starting to get very crowded. So maybe I should watch this, or maybe I should reduce my position size or get out or something, right? because the risk is that there can be an event here. And if there is an event, then, because we can't predict the events, right? But if there is an event, there could be a massive move because the market is so short here. And that's really what happened. A lot of these trend following firms had a very, very tough period during that fixed income move after the banking crisis. And this maybe can help you as a trend follower to think about your portfolio and maybe where you need to reduce stuff. I would certainly want to be short if two markets were moving exactly the same down, let's say, in parallel, and one everybody was short and one nobody was short. I would certainly want to be larger in the one that nobody was short versus the one that everyone was short, okay, by definition, because as I spoke about in the beginning, over time, the masses lose money. So I don't want to be positioned on the masses side, right? But trends do work. So let's be in trends where everybody is not participating. Those are the better trends to be in. And this kind of data and this kind of analysis helps you to find that type of stuff. So the last thing I wanted to talk about today is what I think is really the most important things about how to make money over time. And let's start with what I think is actually the least important thing, which is the ability to pick an asset that is going up or down. And I know that sounds strange because we're either getting long an asset that we think is going up or we're getting short an asset that we think is going down. But the ability to predict the future like that is something that really nobody has, okay? And I always quote Stanley Druckenmiller, who has had an immense amount of success as a trader. And he has a great quote where he says, I am wrong way too often to count on being right or wrong as a way to make money. And I think that's the point, right? What's important is risk management and discipline, right? You take it to an extreme example. Your system could be, I'm going to flip a coin, and if it's heads, I'm going to get long, and if it's tails, I'm going to get short, okay? Then if that's your process, then when it's heads, get long. When it's tails, get short, okay? Don't be second guessing, right? Because the time you second guess is a good chance is the time that you wish it you didn't, right? But more important is the risk management of that. Okay, I'm going to get long, but where am I going to stop? And if that is where I'm going to put a stop, then put that stop and execute that stop. And stops are a very difficult thing because I feel like over time, 80% of the time that you get stopped out of something, you wish you didn't, because the market goes right back the way that you wanted it to go after you get stopped. And that's horrible. But you have to keep in mind and remember and plant it in your mind, the other 20% of the time, the stops will keep you from going out of business, right? And I like to say over the long term, the main point in this is you have to stay alive long enough to get lucky. All right. If you're not alive because you've blown out, you're not going to be around to make money later. So you have to have the discipline to focus on the risk management, right? Those are the most important things when it comes to trading. And that's what you have to really, really be disciplined about and really, really be focused on. I mean, yes, spend time trying to figure out when is a market going to go up and when is a market going to go down according to your thought process, and do an honest job of analyzing if your thought process is working or not. And if it is, then go with it. And if it's not, then try to figure out a different thing. But even within that, risk management is the key to it all. And my returns and my process, I feel like, are proof positive to that. Because like I say, less than 40% of my trades make money. So I am right less than 40% of the time, yet I haven't had a down year in over 20 years, okay? Because my risk return is good and because my discipline of getting out of losing trades is good, right? That's where I feel like my major edge is. And that's what you have to focus on. And on that note, just to do a little bit of plug, I have a webpage called crowdedmarketreport.com. And this was started a couple of years ago. I was introduced through various bunch of coincidences to Jack Schwager. And I met him a few times and I had sent him my stuff and my returns and all that. And he decided he wanted to put me into his latest book, Unknown Market Wizards. I went in that book mostly because his first books had such an effect on me, such a positive effect on me. I thought it would kind of be cool to be a part of that. But when the book came out, I started getting a lot of requests from people through various sources like LinkedIn and whatnot, asking me if I could help them learn how to trade or if I could mentor them. And I did want to do that. I'm entering the very final stages of my career here, quite frankly. My last child is about to graduate college, and once that happens, I feel like I'm going to reduce what I'm doing somewhat in the markets. And I have made money in the markets over time, and that's great because it puts food on my family's table. It allows my children to go to college and all that. But ultimately, as you get older, as a young person, that's all you're thinking about. I just want to make money. I want to pay. I want to get a house. I want to get a car. I want to have money, all that. But once you get older, you start to realize that there's more to life than that, right? And sure, I've made money by picking off some of the weakest traders in the world, right? And I don't apologize for that. That's my job. But as a more broader kind of legacy thing, right? I've gotten to a point where I would very much like to give back to other people. And so people were asking me if I could do this, and I wanted to, but I found it was going to be impossible for me to sort of mentor or help, a few hundred people at the same time. I have a job, I have a family, I have somewhat of a life outside of the markets that I want to spend time on when I can. So how was I going to do that? I didn't really know. And that's what I kept telling these people. And one of those people said to me, well, what about if I start a web page and you can centralize this whole thing and people can join? And I had this newsletter that I have been writing for myself for over 20 years every weekend just to get my thoughts in order as to what I wanted to be doing. And that had been distributed when I was at a hedge fund to some of the portfolio managers there. And then when I ran a hedge fund for a while, some of my clients were some hedge fund managers themselves, and I was managing their personal money and I was distributing it to them. And those people always seemed to like very much what I was saying, if for no other reason that it was a little different than what most people are looking at. And smart people who care about making money understand that looking at something different can help. So we decided we would start this webpage and I would distribute this newsletter. And that was kind of the idea. And then the guy who started it, who's my partner, added a Discord page, which I didn't know what that was at the time, being an old man. But that has actually added a lot of benefits as well, because people get on there and they talk about A, the stuff that I'm talking about, and B, stuff that they're looking at as well. And we have a lot of different eyeballs on the markets and a lot of different thought processes on the markets. And it's really been, I think, a great thing. It's helped me become a better trader, quite frankly. Here's some things I didn't think about before. Here's some, we're looking for these news failure events on different markets. Well, now we've got, instead of just my eyeballs on it, we've got hundreds of eyeballs looking for that type of stuff. So that's kind of what crowdedmarketreport.com does. And what I will say is, one of the things that really makes me angry is the amount of sort of scammers that are out there, that we get the ads on the internet all the time from these people. And, oh, look, 90% of my trades make money. And here's a guy that made $20,000 in a week listening to me and all this. And it's all shrill, okay? There is no guru out there that's going to tell you how to make money. And there is nobody out there that's going to teach you how to turn $10,000 into $1 million in a year. It doesn't exist, okay? I'm sorry to say it doesn't exist, but it doesn't exist. And I don't, on Crowded Market Report, I don't present myself as a trade picker, okay, or as a tipster. While I do every week talk about the trades that are set up for me to do, and I show the trades that I actually am doing. And when it then flows to the daily Discord page where we're talking live time about, hey, this trade was set up. Am I doing it? Am I not doing it? I do that stuff, okay? And you can see what I am doing. But I continue to push the idea of that is not what you want to do. That's what I do. You have to do you. But this stuff can help you. A, the data that I look at. B, the different way that I sort of approach markets, looking at participation rather than price. See all the people that are on there. This stuff can help you do what you do better, which is really what it is there for. So if you are interested or at the point in your trading journey where you think that type of stuff would help you, then we would be more than happy to have you join us on Crowded Market Report. We've kept the price extremely affordable. The idea of this thing is not for me to make a bunch of money. It does cost some money, but it costs money to run the site properly, and you'll see that we run it very tight. There's not only my newsletter every week and the Discord page, but there's also the commitments of trader charts that I know you can get somewhat for free on the internet in some places, but not the charts that we have on there. We have very interactive charts. We cover more markets than anybody else covers. You can change time periods. You can do all kinds of stuff on there. So you get that as well. So if you're interested in that type of thing, then we would love to see you on Crowded Market Report. And if not, that's understandable as well. I do videos on YouTube, which is free, once a week, talking about these type of things. I'm on Twitter. I put some ideas on Twitter. So anyway, that would be the last thing I have to say. I hope that what I've done here has helped people a little bit. And I am, as always, looking forward to sort of the questions and answers and all that type of stuff. So thanks for being here. Thanks for listening to me ramble for a little while. And I hope that everybody continues to pursue this journey of trading success. All right. Thanks a lot. Jason Shapiro, signing out.
Welcome to the live Q&A portion of Jason's presentation. I hope you guys all really enjoyed that. I know I got a lot out of it. It reinforced a lot of the concepts that other presenters have talked about today. Risk management is incredibly important. To start things off, Jason, I just have a few of my own personal questions that I want to ask before we move on to the audience. But while I'm doing that, please, anybody who's watching who has any questions for Jason, let us know down below in the live chat. To start with, let's go ahead and I'd love to ask you, first of all, when it comes to discipline and following your process, which you mentioned at the end there, I'd love to hear kind of your thoughts on, I know you watched a few of the previous presentations on trading psychology. Is there anything else you wanted to add on that subject about, becoming more confident, becoming more disciplined?
I mean, one guy that I worked for one time used to say all the time, trading is discipline. So that's what this is. If you want to be a trader and you want to be a profitable trader, discipline is what you need to be thinking about. Process, discipline, risk management. That's what you need to be thinking about. People are trying to spend a lot of their time, obviously, trying to figure out if the market's going to go up or down, and clearly that's somewhat necessary. But the other things I can tell you are 100 times more important. So, yes, the only thing I can say about discipline is, and I'm speaking to myself too, by the way, get better at it. Mm-hmm. Spend time getting better at discipline, because that's the game.
And on the kind of confidence side of things, how did you kind of develop confidence in your process and in your personal strategy?
Just over time, I mean, first of all, my process fits my personality. Mm-hmm. So it kind of, and clearly over time, as it started to work, you develop confidence in it. I still, every day, am waiting for this whole thing to blow up in my face. But this is what I do. So this is what I stick to. Every time I go through a drawdown, I'm like, oh my God, but the truth is I stick to it. I stick to it. I stick to it. It helps me, in fairness, a lot, because I manage a business where I manage money for people who have given me money for this specific purpose. I fit a purpose in their portfolio.
Right.
So therefore they're paying me to do that. So that's what I do. Right. So that helps me a lot with my discipline, quite frankly, because I'm here to do what I told them I would do.
Right.
So I stay disciplined to that. That helps.
Yeah, perfect. And I saw a few questions about where people can find the COT data. Do you have any recommended sources for that?
So COT data is available for free. It comes right from the CFT website, and the data is there and you can download it. I can't, because I am completely incompetent, but anybody that is competent in computers whatsoever can download it for free from the CFT website, right? There are places all over the internet, all these different whatever chart places and stuff that show COT data with their charts. You can see it there too. So you can get it for free all over the place. We have our own COT charts on Crowded Market Report. I like to believe they're the best ones out there. I used to pay, because I didn't like any of the free stuff, I used to pay a place to get COT charts. And it's not a lot of money, but I like the way it was presented better than any other ones. But my partner, who started this Crowded Market Report, went and developed much, much better charts for that. First of all, he covers a lot more markets. Second of all, he's made it very, very interactive. You can change the dates on it, you know what I mean, to whatever dates you want. You can also combine it if you want to look at, instead of S&P, what's the commitment of traders on S&P? You can say, okay, what's the commitment of traders on all equities here? Russell, S&P, Dow. What's that look like? I haven't seen anywhere that can do anything like that. So that's available on our website. But like I say, you can get decent COT charts for free out there.
Yeah, perfect. And I saw there was a question earlier in the chat which I know you answered, but I think it'd be good to kind of reiterate. What kind of markets do you trade? And I saw that some people asked specifically about crypto and Forex as well. And are you kind of market agnostic? Do you not really care what the particular market is, just what the signal kind of tells you?
I do not care. There's no difference to me between S&P and soybeans. I trade all the U.S. futures markets because that's what this commitment of trader is available on, U.S. futures markets. So I trade all the U.S. futures markets that have liquidity. So there's basically 37 markets between the stock indices, the fixed income, the currencies, the commodities. I do not trade Bitcoin, but we do, obviously because there's been a lot of interest in it, we do present in my weekly report, the commitments of trader charts for Bitcoin and Ethereum because there's futures markets on it now. And I will comment on what that looks like. And so far, the commitments of traders has been very, very good for Bitcoin because it shows speculators way too long up there at 36,000. And then it showed them way too short down there at whatever it was, 17, 16,000. So it was kind of giving a sell up there and it was giving a buy down there. So it's been pretty good so far in that.
First of all, I know you've kind of recently joined Twitter, which you're definitely a recommended follow. Definitely go ahead and check out Jason. Have on there, obviously, there's a lot of traders talking markets, talking trading, taking that into account, and also just your own personal experience with your service. What do you find are some of the biggest mistakes that traders make, and what are some things that they can do to correct that?
I think the biggest mistake that traders make is they try to outsmart the market. And this year has been a perfect example, right? Everybody knew that the recession's coming. Everybody knew that the economy is going to be bad. Everybody knew all these things and everybody was shorting. And they have gotten their face ripped off, right? And I think that's the biggest mistake people make, and a mistake that I myself was very guilty of in the first 5 to 10 years of my trading, right? In particular, when you have winning trades, all of a sudden you think you are smarter than the market, right? I think that you are going to learn over time that you are not smarter than the market, and that will kill you, right? So I think that's the biggest. The other one, and Warren Buffett, of all people, has said this one too, is people try to correlate the economy with the markets. And the famous line is, the markets are not the economy. And you better believe that. I have done videos where I have shown this stuff and written papers that have shown this stuff, where if you correlated the economy to the market, if I had given you all the economic data a year in advance, then you would have done this and you would have lost money doing that if you were correlating market to economy. I think one of the great ones, and I know there's plenty of counter arguments to this, but just because I was involved in the Hong Kong market for a long time, because that's where I started trading when I lived in Hong Kong, the Hang Seng when I was there in 1994 was like 13,000, okay? And at the time, in 1994, China had nothing. I was there, okay? It had nothing. The tallest building in Shanghai was 18 stories high, all right? And from 1994, I went back to Shanghai for the Olympics. Well, I went to Beijing for the Olympics, but we visited Shanghai in 2008. So from 1994 to 2008, Shanghai was the biggest city in the world, right? Forget about 18, there were now no 18-story buildings because there were 8 million 80-story buildings, right? Makes New York look like a backwater, all right? And in that time period, the Hang Seng Index went from 13,000, and look where it is now. It's at 18,000, right? And at the time, I was a 22, 23-year-old kid, and the obvious trade was China was going to grow because that was right when China was opening up, right? And as a young person, that's where I should be putting my retirement money, into Hong Kong or China, because that was going to have the biggest growth in the world. Well, it did have the biggest growth in the world. That was 100% right, okay? it had probably, I would argue, for 15 years, the biggest growth in the history of the world. And the Hang Seng has gone from 13,000 to 18,000. And the Nasdaq in that time has gone up God knows what, right? And even the S&P has gone up much, much more than that. So I think that's sort of proof positive that you could have the economic data before it comes out, and it's not going to help you because the correlation is just not there. So I think those are the two biggest mistakes people make.
Yeah, perfect.
Every time I see somebody on TV and the question is, well, what do you think the market's going to do? And their first line is, well, the economy. Okay, but that's not what I asked you. I didn't ask you what the economy was going to do. I asked you what you think the market's going to do. And that's always the first answer. So I think that's a big mistake.
Yeah, for sure. And another question I want to ask you was, is there a loss that stands out to you looking back at your career that was very meaningful, that taught you a big lesson? Is there a particular one that stands out, or it's kind of all a wash?
I think there's a number that stand out, but certainly late 99, the second half of 1999, right? And this was before I started using COT data, and this is actually what pointed me towards COT data. But the second half of 99 was a humongous bubble in the internet. We all know that in retrospect. I knew that in real time because it was obvious, right? The shoeshine boy was giving stock tips, right? We all know what that means. So I knew that that was a ridiculous bubble. I had friends who were telling me how they turned, $100,000 into $5 million by buying all these stocks, and they were all heroes, and, they were all going to be very rich and all that. I knew it was a bubble. And I got my ass kicked because the second half of 1999, that bubble went up another 40 to 50%. Okay. And by the time it ended, I didn't have no money left to trade to take care of the shorts. Right. So that had a very big effect on me. They say the market can be irrational longer than you can stay liquid or whatever. Right. That was what I lived in that. And that was when I found the commitments of traders. As it turned out, the commitments of traders didn't show people crowded long until like January or February of 2000. So it would have kept me from shorting that market all the way until January or February of 2000, right? Which would have saved me, I can tell you, a hell of a lot of money. Right? And that's really when I started to look deep into commitments of traders, when I saw that. Because trying to be contrarian, okay, but contrarians get run over, in particular if you're just doing contrarian price. All we need to do is look at NVIDIA. Recently, as a recent example. NVIDIA, for all I know, let's call it 50 times overvalued here, all right? Just for argument's sake. Okay, but that means that 100% ago, which was only about 2 or 3 months ago, it was 25 times overvalued, right? So if you were shorting it because you knew for a fact that it was 25 times overvalued, you've lost 100% on that trade, man. You've gotten crushed, right? So you can't just do it because of what you think. You need the market to tell you when. However you define that. I have my definition of that. You could have your definition of that. It doesn't matter what you really use. You have to use something. Use a moving average. Use a reversal day on the candle. Use whatever you like to use. But don't just fight it because you think XXX. Because thinking is what's going to get you in a whole shitload of trouble on this. It will work sometimes, right? But over time, it's going to get you in a lot of trouble. Take it from me, because that's what happened to me, and it's what happened to essentially everybody I've ever known. So you're not going to be different.
Yeah, perfect.
I know you want to believe you're going to be different. We all want to believe that we're different, right? But we're not. There's a normal distribution curve. We all fit in it. And I always say, there's one person out there, arguably, who is the single smartest person out there, okay? That's not even enough, because the market price of something is the combined knowledge of everybody out there. So you don't have to be the smartest person out there. You have to be smarter than everybody combined out there. And that's impossible. Einstein wasn't that smart. Nobody's that smart, right? And I like to point to Druckenmiller. I think I might have said that in the interview, but Druckenmiller is a humongously successful trader. We can all agree to that, right? I have a client who has had money with him for 25 years. And he says the guy writes up these monthly things. And he says he writes so well. He's such a smart guy. He writes so well. And he writes in such a clear way. And he's wrong 80% of the time, okay, about what he says. He makes this whole economic argument and the whole this and that. He says the guy writes beautifully. If you were to read it, it would convince you would want to put those trades on. He's wrong 80% of the time. And yet he makes money consistently. And he has said it himself. I am wrong way too much to count on being right as a way to make money. To me, that says it all. Stop trying to be right. Just to make money.
Yeah, perfect. And I know you mentioned that you may want to share some charts. Do you want to go through a few COT charts live and kind of talk through how to interpret them, or what would you like to do?
I guess if I were going to talk about something like that right now, if we're going to talk about the current market, I would share, I hope I can do this because like I say, I am just so incompetent, but let me try and share. Can you see that?
You may have to press share screen first. And
Right,
while you're doing that, please let us know if you have any questions for Jason in the live chat. And yeah, it's just coming up right now, Jason. So perfect. I see Excel.
Okay. So this is what I've been looking at all day today. And what this is this is the commitment to traders charts for the combined fixed income, 2, 5s, 10s, and 30s. All right. And the red means commercials. The blue means speculators. At market turns, what I'm trying to do is fade these speculators and go with these commercials. So this would indicate I should be getting long fixed income at some point here, right? But it's very interesting to me what's going on in the fixed income world here, because on the one hand, the Fed continues to tell us that they're not lowering rates, right? They're going to stay higher for longer. They might pause, but they're not lowering. Higher for longer, higher for longer. On the other hand, the pricing in fixed income, which can be measured mathematically, the fixed income markets are telling us that they are going to lower rates 2-3 times by the end of this year, which is only 6 or 7 months away, right? So there's either the hugest opportunity here. If they're not going to lower rates by the end of this year, then being short, especially the short end, like the 2 years, is a humongous opportunity. Well, I always look at it like the markets don't offer you opportunities like that, right? Something goes wrong, right? So this is showing speculators are massively short fixed income, the most they've ever been by a long shot. The old record was here, which is, sort of towards the end of 2018. And by the way, this is right where fixed income bottomed in 2018 and had a humongous run up here. I just feel like this is something to keep an eye on, right? I'm not saying it's going to happen tomorrow or this week or anything, but I feel very strongly something is going to happen here. Now, I understand, from what I understand, a lot of this has to do with the fact that these big hedge funds have essentially not made money in stocks for so long here, right? Because it's been so hard. They've all been short because of the fundamental stuff and all that. They've kind of given up on trading stocks, and they have now focused on trading this fixed income. They go back to their old fixed income basis trade, right? Where they'll make 1 penny and they'll leverage it up 100 times. And I think that's what this is a function of, right? What I know is that always ends badly, all right? It's ended badly many times in my career. Simply because of something will happen somewhere and they'll have to cover these trades. And because they're all so short, there will be nobody to sell it to them, right? It's just like what happened with LTCM. The LTCM trade was 100% right in the end, but they blew out on it because something happened. They had to get out of the trade because they were too leveraged and everybody else was too leveraged, and they couldn't get out of it because there was no buyer, right? And so they blew up and the trade ended up being 100% right. That's what kind of happens when things get this crazy. The timing's a different story, but that's what I'm keeping an eye on right here. I think it's extremely, and we can get into what's going to happen. You know what I mean? If the economy actually starts right as people are now starting to give up on this recession thing, they're just starting to give up on it, right? And you can go back and look at my videos and my interviews and stuff at the beginning of last year. I was saying, at the beginning of this year, the end of last year, I was saying this recession thing is just way too in the market, right? Looking at the positioning and everything, everybody's bidding on this recession saying, I don't think the stock market's going to go down until they give up on it. They're starting to give up on it now. So right as they give, I'm guessing that this could happen, but right as they give up on it, now it comes, right? And all these people that are shorting fixed income are going to get burned. When they get burned, it's going to be ugly. So I just think it's something to keep an eye on. It's not anything that I'm trading. Look, I'm long stocks and all that kind of stuff, but it's not something I'm doing right now, but it's something that I am keeping an eye on very closely here.
Yeah, perfect. And taking a step back, would you mind kind of walking through this chart and explaining the different components and kind of how you incorporate it into your analysis, just for people who are completely new about this?
So let's take a little better one, because that's a long-term one. It's kind of sometimes hard to see that. But all right, here it is. You see that?
We go. Yep, we see it.
So let's just take the 2-year notes, okay? So what this says here, the red is the commercials, right? So it breaks down that there's 3 types of people that trade, right? As they're divided by the CFTC, right? Which is, you have a commercial trader, which is the red. A commercial trader is, let's say in wheat, a farmer. He actually has wheat to back up his trades, right? And the reason he wants to declare himself a commercial trader is because he gets lower margin rates, because he actually has the wheat behind it, right? So everybody else is a speculator. There's a large speculator, which is this blue line, and a small speculator, which are these yellow lines. The large speculator means there's a certain number in each market where if you have that many contracts, you have to declare it. And they do that because they don't want people to be able to corner a market, right? Mm-hmm. So if you're one of those people, you're in the blue. And everybody else, that's 1 lotting, 2 lotting, 10 lotting, whatever, is the yellow. So this shows that the commercial and commercials are going to be equal and opposite to the total of the speculators, right? So where I trade it is when all 3 of these match up, right? Commercial super long, large speculators super short, and small speculators super short. So this is why I'm not long fixed income here, because you can see the small speculators, the yellow, have been long, right? And when you test this data, the small speculators are the worst of all of them. So I don't really want to be on the same side of them, right? So if we can get to a point, hopefully, where fixed income keeps going down and these small speculators get out and they start getting short to match this, at that point I will be looking to get long fixed income. And God knows I hope it's soon, because I could use it in my portfolio. But whenever it is, that's when I will have it. So that's kind of how this data breaks down.
And how do you kind of define extremes? What tells you that the large speculators are getting extremely short a particular market?
So I take this data and I turn it into an oscillator. And they're just like any oscillator, there's a look back period, whatever it is, 1 year, 9 months, you know what I mean? And that oscillator tells me when it gets to 0 that, they're super short, and when it gets to 100 that they're super long. And that's when I look to make a trade. And
once you're in a trade, you're watching for it to become neutral. Is that correct? The oscillator?
Yes. Once my oscillator goes to 50, I'm out.
Mm-hmm. Perfect.
So that means that it like people get confused. Okay, the oscillator goes neutral, I'm out. That doesn't mean now the market is going to go down. The market might keep going up. It's just going to go up without me, because I did my job. I caught that turn. That's my job. Right. From here, it's the trend follower's job. And clearly, if they went from super short to neutral, it means the trend followers are getting in, right? Because a lot of these guys are trend followers, right? The blue, large speculators, are essentially, not all, but a lot, is the CTAs/hedge funds, which are trend followers, right? And at the end of the day, macro investing is really just medium-term trend following also. So if they're getting in, I'm getting out. And then if it keeps going up, good for them. They can make that money, right? But what I find is, and it makes sense, but the volatility after that point increases, starts to go up a lot, right? Which is why you see the returns of trend followers being a lot more volatile than their returns, really. Their sharps are less than 1 because they're playing in a very volatile space, right? And I don't want that in my returns. I like where my sharp is. And B, that's, like I say, that's their job. This is my job. That's their job. Let's all just do our job.
And the open risk line, the green line there, is that something you consider at all, or that's
Not
not really part
really.
of your
It's just part
process?
of the chart because people like it. So we put it on there. That's the open interest, that's just the open interest number. And we're starting to build the charts too to try to get price on top of this as well. So I know my partner is in the middle of doing that project now because a bunch of people have requested that.
There's a question about why, in particular, you don't like to trade Bitcoin.
It's not a question of I don't like it. It's a question of, first of all, I need history of data before if I'm going to set an oscillator on a look back, you know what I mean? I can't do something with something that's been trading 3 months. Now, Bitcoin has now started, the futures have now started to have some time period in there. So I theoretically could start to build it and start to trade it. To be quite honest with you, I think a lot of it comes down to laziness. I've been trading these 37 markets for 22 years. For
You don't
me
need another one. Yeah.
I mean, you could always use one, I guess, to diversify. But the truth is I have to then go to my clients and say, I'm adding a market. And then we have to go to the brokerage houses and get that market approved by the brokerage houses. And we have to come up with limits. And quite frankly, I think I'm just too lazy to do that. I don't need to hear it. Oh, why do you want to trade Bitcoin now? Oh, well, we have to come up with limits. And then the brokerage houses are so wacko with the Bitcoin limits these days anyway. They're probably not even going to let me trade enough of them. And it's a stupid reason, but I'm just too lazy to deal with that at this point in my life.
Yeah, fair.
But we do cover it. Like I say, we cover it. And it has made, let's look, crypto. You can see here. This is August, okay? Speculators super long here, right? This is where we're looking to get short Bitcoin, right? And here's January, right? Speculators are getting super short, right? This is where we're looking to get long. So we're getting short Bitcoin in August and we're getting long Bitcoin in January. And then we're looking to maybe get short or at very least out of those longs just 3 weeks ago. And now the speculators are actually getting out of those longs. So maybe Bitcoin can move, but people are wondering, well, how come Bitcoin, the Nasdaq, remember Bitcoin used to be so correlated to the Nasdaq, right? Well, the Nasdaq has ripped and Bitcoin's gone nowhere since here. And if you can ask me why, I'm going to tell you it's because the speculators were too long here. So maybe now it can start to move, but it's only neutral, so there would be no trade here. But another interesting one on this was as that was going on, we're showing speculators super long this Bitcoin here, and we're showing speculators super short the Ethereum here. So you could think about at that point, which was earlier in this year, going long Ethereum versus short Bitcoin. And I don't follow it closely, but I believe that's worked. I think for the first time, everyone's been talking about, from what I understand, for a couple of years, how Ethereum was going to be the new thing and it was going to outperform Bitcoin. It never did. And it started to right here. Now, you can tell me a million reasons why that happened, and I wouldn't be able to argue with you because I don't follow it close enough, but I can point to this and say, this would have told you, without knowing anything about any of this stuff, this would have told you be long Ethereum versus short Bitcoin here, right? Right here, 411, right? 411, right? Be long Ethereum, be short Bitcoin from April 11th. And I believe, if I'm not mistaken, that's worked. I believe Ethereum has outperformed Bitcoin in that period.
And are there any common mistakes or misinterpretations that newer traders first looking at COT data might make in your experience?
Yes. The first thing and the most important thing, and the thing that I tell the people on my Discord and everything almost every day, is that just because a COT trade worked, like a trade using this data worked, doesn't mean it works every time, all right? It does not work every time. I can assure you, with the amount of losing trades that I've had, it does not work every time. So you have to be very disciplined in the use of this, right? And I talked about that, I think, during my presentation. There's other things that you have to do on top of the COT data to make sure that you're not catching, you're not getting caught in the losing trades, like what might look like, even if we look at this Bitcoin, okay, right here, this looked like the large speculators were super short, but look what happened next week. They got even more short, there's no limit to how short they can get. So that's be careful, number one, right? Just because they're super short here doesn't mean that it's going to look like that in a month. And we can go through that with just about all these things. The 2-year notes here, they looked super short here, right? And look how much shorter they got, right? You have to be, and it doesn't just change with the COT. It's with every single trading process you use. You have to be super, super patient, right? Wait for the market to confirm whatever it is you're doing, whether you're using COT, whether you're using, I don't care what you use. The most important thing for me is wait for the market to confirm your view and then go with it. Don't fight the tape. These are all very old adages, right? But they mean something. Do not fight the tape under any circumstances. You'll never catch me buying something just because COT says it's crowded, all right? Until the tape confirms it. And even then, it doesn't always work, right? But until the tape confirms anything you want to do, you just have to wait, right? That would have helped you not have been short NVIDIA. Arguably, NVIDIA Friday, you could call the tape confirming, okay? Because the market's ripped, NVIDIA went down, all right? So if you wanted to call that confirming by the tape, okay, then short NVIDIA on Friday, right? I'm not condoning that, but that would have been the first time that you should have shorted NVIDIA was Friday. Would have saved you a hell of a lot of pain over the last 3-4 months. You know, you're talking about 100, what's NVIDIA up this year, 180% or something, you know what I mean? It would have saved you a hell of a lot of pain because you were shorting it because it was overvalued. Let the tape tell you when. If you're going to be right, you're going to be right big. So let the tape tell you when. Don't fight it and don't try to be smarter, is my point.
And you just stop to keep those losses small if you're wrong.
That's right. If you were to shorten a video on Friday, well, then if it goes through the highs, then cover it.
Right.
You know, get out.
And you mentioned something in the chat as you were answering a question that I found really interesting. You mentioned that you don't raise your stop loss. You keep it at that original level throughout the length of the trade. Could you kind of talk about that process and how you kind of arrived at that methodology?
So it matches, first thing is it matches my process, right? My process is I'm picking a turn, all right? So whatever your process is, what is telling you that it's right and what is telling you that it's wrong? If it's right, then stick with it. If it's wrong, then get out. So I'm picking a turn. So what tells me that I'm wrong? Well, if I'm buying something and it goes to new lows, then clearly I didn't pick the turn. It's that simple, right? So I stop out. Anything in between those, right? Okay, if I'm right and it goes up, well, now you're just in randomville. The market goes up, the market goes down, the Fed says this, the Fed says that, this and that, and the other thing. It's just randomville, right? How many times, I mean, I've essentially been long the stock market this whole year, right? How many down days were there during that period? You know, how many times would I have, if I had been trailing stops, would I have gotten stopped out? You know, and then how do I re-enter? Because now I don't have my process to know when to re-enter, and it just becomes a shit show, right? And I used to do it where I would, and I was pretty good at it. I would get out of my position at a very good level, and it would, like, let's say I'm long, I would sell it. The market would go down, and I would think about what a hero I was, trading around my position. And by the time I got back in, it was gapping back through the highs, right? And now I can't do it because now my whole risk thing has changed, right? I'm buying it back higher. Now my risk is all messed up. So I don't do that, you know, and obviously I've been able to test all this stuff in certain ways, and it has shown me that trailing stops do nothing. You know, people were talking earlier about how, oh, the algos will target your stops, right? And that is true, right? So it purposely, they stop me out. And now I wish I didn't get stopped out, right? So I just sit on it. If I'm buying a market low, then by definition, the market is going up. And I just want to be there. I personally don't have any ability to forecast the path of how that's going to happen, right? And I need to be there because less than 40% of my trades work. I need to be there for the big trade. You know, I need to ride, you know, the Nasdaq up however many hundreds of points, right? Because I have a whole bunch of trades in the meantime that are stopping me out and stopping me out and stop. I need those to pay for my losers. So I just sit on them. I'm not interested in this randomville stop out crap. And does it happen sometimes that I buy something and it goes up a whole bunch and I'm happy, and then by the time I get out, it actually goes all the way back down and I get stopped out and I miss out on, I had a winning trade that turned? Yes, it happens. And does it suck? Yes, it sucks. But over time, that makes me more money than the other thing. So that's what I'm interested in doing. And I think that's a very important thing for people to understand. You don't find this out until later when you're older and it's too late, right? It's all about over time, right? It's not about what you make today or this week or this month or this year. It's all about over time. That's where you're going to make money. I went 10 years of this whole make a bunch of money, lose a bunch of money, make a bunch of money, lose a bunch of money. And suddenly I was 32 years old and I had gotten nowhere, right? You can't get that time back, So this all has to be about over time.
Yeah, I think that's a really
and the only way to do that is to stay small in all your trades. A guy in my Discord was saying it last night. One trade should mean nothing. When you can get to the point where one trade means nothing, then I think you're doing it right.
Yep, excellent. I think that's a really important point. And with regards to the COT data, is there anything else with the charts that you really like to emphasize? Any special situations or anything else that you'd like to cover before we wrap up?
Not really. I think this is a very, this is a very hard thing to do. I think people need to realize that. It's a very hard thing to do. It's, to me, I think that being a fireman and going into a house and saving people's lives is harder than this, because no one here is risking their physical being. But as far as a mental exercise, trading is a very, very hard thing to do. And know that 95 to 98% of the people lose money doing this over time. Know that. And I know you want to believe that you're in the 3 to 5%, and you could be in the 3 to 5%, but think about how that's going to happen. You better be doing something different than those other 95% of the people. Otherwise, you're going to end up just like them. And as I did until I changed and learned, and as other people did. And what made me change and what made me learn? People like to think it's like this romantic thing where, I kind of stuck my process and I learned and I did this and I did do all that, but it was completely out of necessity. Okay. I was unemployable. Nobody wanted to hire me because I was such a, contrarian. No one wants a contrarian sitting next to them. A big part of hiring is can the person sit next to you and deal with you, right? And I was very hard to deal with as a big contrarian, So I had to do it out of necessity, right? And necessity is the mother of invention, as they say. I invented this whole thing out of necessity. So you have to kind of approach it like that. This is a very, very, very difficult thing to do. Know that going in. I know that you had success at some point and it seemed like it was easy, okay? And now you've probably learned, most likely, given what the last 3 years have been, you've most likely learned it's actually not that easy. It's not, okay? So think about that, because that's extremely important. What are you doing that's different than these other 95 to 98% of the people? And I can tell you that your ability to pick Fibonacci numbers ain't it. It just ain't it. Your ability to spot breakouts on a chart, it ain't it. Okay, everybody can spot breakouts on a chart. They all do it. You can go on Twitter and you got people that are giving you their list of chart breakouts and all that stuff. It ain't it. That'll work sometimes. In a bull market, if you're buying breakouts on charts, there's a good chance it'll work, right? But then in a bear market, it won't, And even this year in a bull market, it has not worked on a bunch of things. It has certainly worked on these tech stocks, but then you have to say, it's breaking out, but it's, 1,000 times, revenue. So how the hell am I going to buy that, right? So that's really what I would concentrate on. What are you doing differently than these 95 to 98% of people that are losing money? Because if you're not doing anything differently than them, you are going to lose money as well. And losing money sucks, to state the obvious.
For sure. I think that's a great point to leave it. Jason, thank you so much for your time. I've learned a lot from you over the past 2 interviews that we've been able to do. So thank you so much for taking the time to be a part of this. I'm sure everybody watching enjoyed as well and got something valuable out of it. To everybody watching, this is our last presentation of today. So thank you so much for tuning in. Make sure to leave a like down below, subscribe to the channel, consider a donation to St. Jude's. And I'll be right back with just a brief closing message before we wrap up day one. So thanks again for tuning in. And Jason, thanks again for being a part of this. I really appreciate it. And we'll be right back. Take care.
Thank you.
I'm going on my 21st year here without a down year, and really just stay disciplined to those trades over time. And I start to develop a process.
One trade should mean nothing.
The market is now no longer going down on what is seen as the most bearish news there is.
Until the tape confirms anything you want to do, you just have to wait.
And it's not just some random stop. It's a stop that actually makes sense, A, on the chart, because it's a new low, and B, according to my process. Don't fight the tape. Don't think you're smarter than the market. And there is nobody out there that's going to teach you how to turn $10,000 into $1 million in a year. It doesn't exist.
It's not about what you make today or this week or this month or this year. It's all about over time.
All I'm trying to do is make money. And to me, the simplest way to make money is to go opposite people that are losing money.